All right, welcome everyone to the Trade Speakeasy and to our Thursday night call. Normally you guys, or Thursday afternoon call. I think normally Jay Foreman is teaching this class, but just to give me a chance to see you guys and to be back with you guys, I thought it would be nice to do a bit of a roundup on the last 4 sessions that we were going through. So we will just be looking back at long calls, long puts, and short calls and short puts. So if you have any questions, hop in the chat, and then Vicky will be shooting those at me while we are looking at some charts and evaluating how, what kind of trades we might be wanting to set up or not in this particular market environment. So all right. So one of the things that, I always like to give you guys kind of a macro overview of what's going on. And, the Bank of England today, they went ahead and they did a 75 basis point hike, which is in line with what the Fed was already saying. And as I've mentioned in our Telegram, that first sentence out of Jay Powell's mouth is the most important. Oftentimes when you're listening to the talking heads or analysts go back over, they're like digging through and like combing through all of the, like sentence one by one and what he's thinking and what he's saying. And that's really not his style. He is by trade a lawyer and not a economist or a PhD or something like that. So he's very pragmatic in how he speaks and how he's responding. And so he always comes out with like clear guidance with that first sentence. And yesterday it was very clear that, they still have inflation targeted at 2%, which a lot of people thought, maybe they're going to accept that some aspects of inflation are going to be entrenched just because of the change in structural issues, whether it's the cost of labor or the cost of manufacturing, and even some of the supply chain kinks that aren't just going to suddenly disappear. So he basically said that's basically hogwash, and no, we're sticking with the 2% target for inflation. And so we need to constantly keep that in our minds that, first of all, yes, inflation is very high and it continues to accelerate. And right now, because of what's happening in Europe, that we've had an extremely warm winter so far, that we've had kind of surprise drop in energy prices recently. But once the real winter hits and we start to see how much the storage in the oil and gas storages actually work, and how well prepared we are for the winter, we could easily see a new acceleration to the upside. And if we have a longer winter than anticipated, even though we have started the winter later than normal, then we will continue to see surprises. So the supply issues for LNG have not just disappeared, and Powell is still shooting for that 2%. And we have some clear systemic issues in the system that are going to keep inflation probably pretty sticky for longer than people are anticipating or expecting. One of the things that I think is really important for us to look at is this. It's a chart called the US Credit Impulse Index. And basically that kind of, it's a lagging, it's a lagging chart, but it does give you the kind of the earmark of where we're at regarding interest rates. And so, or inflation rate, sorry. So right now, no, interest rates, that was correct. So right now, we have only just now come up above like a normal rate. And so right now we're looking at 5.75. But if the rate of inflation is up at like 7%, then it means actually the cost to borrow money is still cheaper than the rate of inflation. And so even though a lot of people are already talking about pressure in the housing market and pressure in all different kinds of markets, really what we have seen relating to recession is in the bond market. And we still haven't seen that kind of like credit crisis of getting the frothy money out of the system, because it is actually still cheaper to borrow money now than what the inflation rate is at like the current moment. So that's really important, because if you want to say that it's too expensive to borrow money, then the cost of borrowing has to be more than the rate of inflation for it to really be like a pressure on businesses. So one of the things we talked a lot about is that in a lot of equities, we're still seeing this press to the downside. And as you can see, I mean, people were already shocked when things like Google and Amazon and all of those things like were dropping, that, you know, could they actually continue to the downside? And I just kept saying that, you know what, I think that a lot of these companies have not adjusted to the fact that they are in an entirely new kind of economic environment. And that economic environment isn't going to get any easier right away. And so until we really see how they retool their business models and how they function without easy capital to borrow, we're not going to see that like just dramatic pop to the upside. I don't think that that's going to happen, but we still have to be aware that, you know, we could easily see in these kinds of heavily oversold markets, we can get these bear market pops. And so, you know, we don't want to be, you know, completely devoid of, you know, just being reasonable that as prices are dropping, if they drop aggressively, that there could be a bounce up. But the question is, after that kind of bounce up from oversold levels, do we find a durable kind of influx of new buyers consistently to allow us to move back to the upside? So with all of the trades you're setting up, you want to be putting yourself in a situation where, you know, if you are going long, so one of the strategies that you guys covered already is this issue of doing long calls. And long calls, if you are getting them, it doesn't matter at what delta. If you're getting them at the money, you're usually at a 50 delta. If you're a little bit out the money, you might see a 30 or a 20 delta. And when you're looking for that delta, what you are expecting is that you're getting the long call as the price moves towards your strike, or your strike starts to move in the money. So whatever the strike was that you got it at, price now is beyond you. You are seeing an expansion in the value of your long call contract. And as long as price is efficiently moving beyond your long call or towards your long call, you should be able to see the price expand, in spite of the fact that maybe volatility of the day is dropping against you, or some theta decay if you have a very short dated options contract. And so what we really want to see is that, okay, if you are thinking, okay, Google at this price could potentially see a really like strong bounce to the upside, at least just for the next 2 or 3 days, like maybe let's say into Monday. So you then decide that you want to buy a call that you are only going to be in for the next, so let's say, few days. So you might buy like a 2-week long call so that you have enough theta in your contract that the theta decay is not dragging you faster than that like bounce up. But you need to have a solid thesis as to why you believe that, you know, Google, of everything in the XLC, the spider ETF for communication services, is like why Google is going to do something different than everything else, right? So you have to have that obviously in your mind, and you might be looking at some technical indicators, like let's say that you like to use the Bollinger Bands, and so you just throw up your Bollinger Band, and nope, that's not the one that I want. Yeah. And you're like, okay, you know what? This is kind of crazy. I don't know what that other Bollinger Band is, so I'm going to remove it so that we're not seeing 2 numbers. But so, you know, you're looking at the Bollinger Band and you're like, okay, Right now, volatility, which is the volatility neutral point, which is the center of that Bollinger Band, is somewhere around the $96 mark. And obviously Google is now at $83. So you might just be doing, making a Bollinger Band play where you think that volatility is going to at least cause a snap back to the neutral point, and that you're going to catch a move somewhere from the $83 point or the $84, $5 point, depending on where we open tomorrow. You're going to buy to open a long call to ride it up to potentially that central point, which is around the 96. Now you might zoom in and say, okay, but there's a huge gap here. So let's actually remove the Bollinger Band, since we already have like an idea of where that is. And let's just plot out this gap down. So the gap down is really also around the 96. So that's perfect. It means that the volatility neutral point is at 96. The gap down ends at the 96. So you could see a price move up to that 96. And so with the long call, you need price to move towards you. If price does like a lot of doji candles for, tomorrow and Monday and Tuesday, and now you have lost, and remember, theta decays every single day. It doesn't just decay on the days that the options market is open. So you have to consider, like, if you buy to open this on the Friday, you will lose the theta of Friday, Saturday and Sunday, and Monday once you open again on the Monday morning. And if price doesn't achieve what you want straight away, you will start to see the theta, or the time, decay from that long call contract while you're waiting for price to achieve its move. Now, a lot of people ask me, but sometimes I see my contract drop and then suddenly I get a big move and then my contract, explodes. Yes, it can happen. You can have enough of a dollar movement that, in spite of the fact that you've lost a lot of maybe volatility value or time value, that outsized move to the upside puts you in profits. But that's not the risk that you want to take as like a habit of practice, because what ends up happening is that one time it might work out for you, but if it doesn't work out for you 2 or 3 times and your long call just expires worthless because the underlying has made an insufficient move to the upside, then you're kind of stuck. And so, but that is a decision of your conviction of where you think that we are going to be, where we're going to be at. Now, as we can see on the MACD, that we're stacked very negative. The average line is, the signal line is well below the average. So basically that just means that we have an aggressive acceleration to the downside. And the fact that the price oscillator piece on the MACD is solid red right here, you can see we have 1, 2, 3, 4, 5, 6 solid red candles, and they are increasing in size. It means that we're not just getting like people aren't active in the market. This is aggressive selling. This is what capitulation starts to look like. And so you might say, okay, Suzanne, I see where you're going with this. You look back at the MACD and you look back at this period where price was also aggressively selling down and here. But even here, when price was aggressively selling, the EMAs had already been turned positive. We're actually negative, and the MACD lines are almost perpendicular, straight up and down. So that is really not helpful. We should have been seeing, by this point, we should have been seeing at least a natural bottoming formation in the lines, not a widening acceleration directly to the downside. So, but some people are really convinced about the buy the dip. And so they're like, but this is such a great price on Google, and I just can't imagine that it's not going to revert to the means. So If you believe that that's what's going to happen, then brilliant. You can get yourself a long call and try to see if you can get an accelerated move to the upside, in spite of the fact that we're not seeing we haven't seen any buying activity come in. So I would, at least if I was going to do a long call, I would like to at least see some kind of rotation, like in the MACD, that at least we're starting to see some kind of bottoming out and then turn to the upside. But of course, some people are like, yeah, but what if like buyers come in and a big institution gobbles up like billions of shares? Of course, we're going to get like a V-shaped recovery and spike to the upside. That's your conviction, go for it. I don't know that I see that in the macroeconomics, nor do I really see that on the charts, but it's up to you. So then you're like, okay, Suzanne, so then what's my alternative? Because of the fact that we've already made such a significant move to the downside and straight down, if we don't get a V-shaped recovery, at least to get us back to that volatility neutral point of $96 on Google, then what could I do? And really what we need to do is we need to look left. We have to look back at where we had, what the trading looked like when Google was at this relative value. So one of the things we have to remember is that Google forever was like up at the thousands, but because of their stock split, obviously now we can still look left and see when Google was at that relative value, what was it doing? And we did have a very significant, volume ledge here. We see that there was a lot of trading happening at this 84, 85 level. And the fact that we have just fallen through this previous gap back here, gives us the impression that, okay, if we try to look more closely at this area, you can see that we have basically cleaned up this gap. And now we are right inside of another gap, which we are technically cleaning up. And the current price is this like red line. It's just giving TradingView is offering that to us. But down here, we're sitting on another massive set of gaps. So this is not a really sturdy price action, because we're actually below that massive volume area, or what should have been a supply area for us, but actually that has become a distribution area. So this area here, which I can highlight for us, if I do it correctly, yeah. So this area here has been, was like a massive volume trading area. And so you would have thought, if buyers were really interested, once we tapped back into this area, that we would have at least seen consolidation. The fact that we just totally fell through it and like didn't even look back is a bit problematic for the pricing of Google. And considering that right at the $80 all the way down to the $77, that $3 range, we have multiple gaps. I think that just poses a bit of weakness for Google. So if you really wanted shares of Google and you're like, but Suzanne, I don't want to miss it. If this thing does have a V-shaped recovery and I'm not in a long call and I haven't bought shares, I am going to be absolutely frustrated. And I can understand, because this feels like the gangbusters sale of the year, right? So what you could do instead, which is also a strategy that Jay talked about last week, is putting on short puts. And by putting on short puts, you are basically playing the bank. And you're saying that if the price reaches or drops below a certain area, so let's say, for instance, you think price could come down, fill this gap, and then shoot back up, you could sell a long put at the $78 range. And what that would do is that would give you a bit of credit. That would bring you in a bit of credit. And then if price were to drop below the $78 mark, then you could decide two things. Either you're going to close the close the put for a small loss if you don't want the 100 shares, or you can take the shares, and because you have a conviction that in the near future price is going to have that V-shaped recovery, you keep the shares, the 100 shares, and then when price rebounds, you sell the shares that you don't want. So if your intention had been that you only want 20 shares of Google at the $78 point, then what you can do is sell that put, and price might not ever come down to you, right? Price might just consolidate for a very long time. And so you might be actually selling week on week on week on week, and you just collect that credit while price is consolidating and making its move and figuring out where it wants to go. And so you're collecting that credit, and then the day that price actually comes down and breaches you, then you can then you have your decision. You will either decide to buy to close your short put for whatever the loss would be. And so how you can calculate or think about the loss is that you promise. So we said that we would sell to open a short put at the 78. And so let's say that price actually comes down on our date of expiration. Suddenly there's a new drop and price actually comes all the way down to 76. So the difference between what we promised to buy it at and where the price actually is $2, and our contract represents 100 shares. So we could decide that actually we think that Google could continue to drop. Bad news has come out. So we don't want 100 shares at the $78 because we really think that price could come down to the $68 point. So then you can pay the difference, which would be that $200. Now, remember, during the time that you've been selling short puts while you've been waiting for price to come down to you, you may have already accumulated more than that. And likely you would have already accumulated at least $75 or $80. That's about how much you can get for selling one single short put on Google if you sell them week on week. Now, if you sell a much longer dated contract, like a monthly contract, then you're likely to bring in about $160. I just know that because I'm constantly looking at the option chain. But you can look at the option chain and you would see that for yourself. Actually, let's go to the option chain on Google. If this will let me, I will roll it over to, yeah. So let me know if you can, Vicki, let me know if you guys can see my chart.
We can see it.
Perfect. So let's say, for instance, you want to sell a short put for that 78. So right now you would get $51 if you sold one contract for next Friday's expiration. But let's say, for instance, you think that Google is going to do a lot of consolidation before it actually gets down to that 78 area, then you can sell further out. So you could sell, that's not even a 1 month time till expiration. So we'll go to the 2nd of December, and then let's recenter this a bit. So, okay, does not want to show me the center strikes. It's just showing me on the call side. That's not helpful because I want to see the puts. Oh, okay, that's right, because it's all at $5. Okay, so here you'd have to make a decision if you want to sell at the 75 or if you want to sell at the 80, because of the fact that there are not each dollar tranche. Now, one of the things that you would want to look at is what is the likelihood of being breached. You can do that by looking at the delta. So if you sell at the 80, you're at the 31 delta. So you have a 30% chance of price actually coming all the way down to you. And right now, the implied move between now and December 2nd is about almost $8. So right now, the broker believes that price will either get up to the $91 range or it will roll down to the $75 range. And that actually means that the broker at this point doesn't think that price has enough propulsion to even get us to where that gap was at the 96 or to that volatility neutral point at the 96 level. But it does take us down to where that other gap was on the downside. So that's not a clear signal that the broker believes that we are going to tank $7 more, but it is auspicious that the $7.50 range actually places us right at the bottom of this double gap that we created back in October of 2020. So if you were to sell at the, let's say at the 75, you would be, and you only sold one put, you would be given $86, which would essentially give you one free share. And then you could just sit in this. And then for every day that you are hanging around this contract and price hasn't come down to you, you would be achieving a bit of the profits. So you would sell to open and receive your credit. And then for every day that price doesn't get closer to you in an efficient way, and you have a bit of theta and volatility decay, you will start to see some of that credit actually bank towards your P&L, your profit loss. And then you would decide at any point between now and the 2nd of December, you have 29 days. At any point, you can decide to buy to close, take profits off the table, or to actually just hang out because you actually think it's an amazing idea to get Google shares at the $75 point if price were to drop beyond you. Now, those are your two options. Now, remember we were talking about potentially doing the long call on Google. So if you were to do that, it would cost you $2.50. So if you bought one call right now at the money, you would, let's see, and you bought it for 2 weeks with the expectation that you would only stay in it for a couple of days because you're expecting that kind of propulsion back to the volatility neutral point, cost you $250. And let's say that you even achieved $2 or $3 move. So if Google were to move from $86 to $83, from $83 to $86, then if we look at the option chain and we work it a bit backwards, so we say that we're buying it at the 86, we think it's going to go up $3, or that's all we're looking for. So we run it backwards so that we can see what happens when price moves up $3 worth of value. And that gives us $4.45. So our profit would be almost $200 if we bought one long call and Google actually moved $3. We would then have moved from, let's see, what is the delta? From the 57 delta all the way to the 86 delta. So you see as price is moving up, that the value of those deltas is expanding. Now, some people say, well, I don't want to experience theta decay. I would feel a bit stressed out. So I prefer to buy a bit more time to avoid feeling stressed out. So if you were to get a similar contract for 3 weeks out, you would then potentially get it. So they don't have the $83. So you would get the $84, and that is $290. And if price were to move up $4, you would achieve $5.30, which actually is not, if you consider all things considered, you would only achieve $1.40. So because you bought more time, you actually need the underlying to move a bit further in order to see the same profits that you would have if you would catch the same move with a slightly shorter dated option. And the reason is because the broker is charging you and paying you based on the amount of risk you are taking. And so the less time you buy, you are giving yourself less time to be correct. And so that is why oftentimes people love these 0DT or very short dated contracts, because they feel the explosion in the price move. The downside is that if you are a little bit wrong and it just takes the underlying a few more days to achieve that move, you will have lost a massive amount of theta because you only bought 8 days until expiration. So you will very quickly see these numbers decay rapidly, because if price doesn't make that explosive move to the upside. So if you have any questions, please hop in the chat either here on, and yeah, I'm sure Vicky will give me a heads up if you guys have any questions. If you're tracking with me and you're like, okay, I'm totally with you, Suzanne, then please put a 1 in the YouTube chat or in the Zoom chat. That way we just know that you are tracking with us. So we will then move on to something like AMD. So this is actually something that we talked recently about. Oh, did you say something, Vicky?
Yeah, Greg has a 1, but has a question.
Yes.
So just Suzanne, looking at your previous chart where you mentioned something about an implied move.
Yes. And
so in the context of selling time, right? I'm going to, and this is just a clarification, when I'm selling the put, I am assuming that I'm going for the 30-day or the 1-month option that you mentioned, the December 2 option. And at that level, what you have there is the implied move for that is, am I reading that as 7.79, correct?
Yep. Yeah, almost $8.
Okay. Is that specific to Think and Swim only, or can I get that on TradeStation or any other thing, or is that just a Think and Swim thing?
So basically it is just a calculation from the implied volatility, so the historical volatility and expected volatility, and then translated to a dollar movement plus or minus. So I believe that you should be able to find it on any trading platform on the option on your trade tab in the option chain. The question will just be where exactly they place it. It's just that on TOS, they place it directly opposite the expiration date.
Got it. Okay, and then in this scenario, because of the propensity for what appears, I mean, we can't predict, but what appears to be down, the selling of the put puts you in, it sounds like a better position than buying the call, buying the long, getting into a long call situation. It sounds like that puts you in a better position given what appears to be a series of gaps and a propensity to drop further.
Yeah, so if that is your thesis, that looking at the chart, seeing those gaps sitting there, you're like, okay, that makes me nervous. Because if you're in a long call and price moves against you, so actually let's say for instance you were even in a long call for the same expiration, and you're like evaluating, do I do the long call or the short put? For let's say that you buy at the 80, or let's say you buy at the 84, because that's almost at the money. You pay $3.90, but price just drops to the $82 point. So it just moves $1 against you. You would already lose almost like 60 cents. So if you only bought one contract, you would have already lost $60 from your $340 investment. So let me see. I don't know if you can, if this is too close, but if you were buying at, let's say that you came in, you got this the $84 long call, it would cost you $340. And if price dropped $1, then you'd be looking at $2.89. So the difference is somewhere around, like 50, like almost 50 cents. So you'd be losing $50 from a $350 investment. And the question is that if it drops more than $1, so let's say that it moves $3, well, then you're starting to lose significantly, and you're losing time. So you're losing the value of the contract, and you are losing time. So you have theta decay and delta decay, and you are then waiting to see if you can recover the value with a swift move to the upside. Where on the flip side, let's say, for instance, the price actually does go back to that volatility point, right? And you got in at this, you sold to open at the $75 point, and then suddenly there was like a $5 move to the upside, or like a $3 move to the upside, you would see a massive change in the value of the delta. So the delta in and of itself would move from 16 to 7 rather rapidly. And basically just with that impulse to the upside, you would be able to buy to close this for almost a 50% profit trigger, just because of that impulse to the upside.
Yeah.
And if you had been in a long call, you would need to, obviously buy to open and then sell to close when suddenly that impulse to the upside actually took place. And if for whatever reason, maybe you didn't catch it perfectly and it retraced, you would have, because a lot of these moves, as we've seen the last few days, because of the amount of volatility in the market, that sometimes we get a big push to the upside, but then we give it right back. And when we give it back often very quickly. So getting in and out of long positions can also be then a bit precarious, where with short positions, usually people already know what they have in mind for their profit trigger, what the percentage is that they want. And so they just leave that order baking. You can still do that as well on the call side, that you have your sell to close for the profit trigger. But often when price is moving very fast, the value of the contract value of long positions actually expand when the price is going in the opposite direction. So what I mean is that let's say that you wanted to catch a $3 move in the value of the contract, you actually need the underlying to move beyond that point and then come back to you. And the reason is that when price is moving opposite your direction in longs, that is when the volatility expands its value in your favor. So that's why people always say, when you're in long positions, always sell into strength, because actually what happens is when it makes that impulse and then has that slight pullback, which price often moves too fast for you to see when that takes place. It's in that retrace moment that the volatility actually flips in the favor of your long call or your long put, depending on your directionality. And so that's why oftentimes when people are looking at their contracts, they're like, wait a minute, the price is like going in my direction, but it's not tapping me out. And unless price actually shoots past your goal and then comes back to you, that's when you'll get tapped out, when it does its pullback, because that's when volatility will expand. Because technically, when volatility is going the opposite direction of the chain, it's more volatile, and you end up being able to get a slightly better contract value and be able to close your position. And so often people are like, have their closing order where they're expecting price to reach, and it doesn't happen like that. Price actually gets to them, but doesn't necessarily tap them out. So those are some of the things you have to consider when setting up your long positions, especially if you're out the money or you want to catch a very big price movement.
Thank you.
Mhm. So now to look at maybe something a bit different. So with Google, like one of the things that, because we've already had really this almost like $13 move to the downside, you might not want to get into a long put because you're like, okay, I think that, it's very plausible that we can just chop around here. Same reasons why you might not necessarily want to do a long call, that, price might not give you another a very significant bearish engulfing candle and give you more gaps down. And so you might not necessarily want to be hanging around in a long put, but maybe something like an AMD where, for a long time, it had this massive gap down, and then it gave us a significant bearish engulfing candle from the 65 basically down to the 58, all in one fall swoop. So basically price just was going down and stayed going down. And then price really couldn't get back over it. It took price a while. And then slowly every single day, even though there was a lot of selling, so you can see in the candles that you have massive wicks on the upside, which means that price tried in that morning volatility to run up, and then the rest of the day was just basically selling and settling action. And then we do have a few days where we have a big bullish engulfing candle, and then the next couple of days we give it back, we give it again back, and then and back and forth. And so we're not making any here. You might say, okay, we're not making really like constructive movement to the, directionally. We're basically just going sideways. And so you might say, okay, we had earnings, we had and in the open, that first day after earnings, we did actually see a massive run up right to the top of this gap down that I already have in the triangle. We rejected it. We tried to come back and basically pick up some buyers, but this is not really constructive movement. So you might actually think that, okay, I think that AMD is at least going to have to come back down to the $54 point before it can really pick up some new buyers. So let's do the same thing that we were looking at before, but let's put on a volume profile so we actually see where those, and we don't need the EMAs. So, oops. So really we came down to this area at the $54 mark. And that's really where, if you see the previous range, we had a lot of consolidation on AMD, and we have been hitting it. So basically, AMD is unlike Google, where Google was actually below it's a major consolidation area. AMD is actually continuing to bounce up off of it and then slowly pick up buyers, but it's not able to really get back. Like, it's not even getting up to the $86 range, even though there's actually no volume ledges. We don't have any volume that should be causing a rejection. Like, technically AMD should have been able to. So we see this consolidation, this strong consolidation area. I will mark it, and then that way we can actually just zoom into the current price action. So we can see that there's a lot of volume trading right here. And now let's scoot this back so we can actually see. So now we'll ignore the volume profile because we're not able to see the visible range that is a bit further back. So here we are, and we had this kind of gradual move to the upside. So we were making higher lows, higher lows, higher lows, and we were making higher highs, even though we were really like aggressively moving between those highs and lows. But on the volume profile, there actually wasn't anything sitting between us at the 60 range and that $68 range. That should have been our resistance. So price really should have come up. Whoops, I don't want this anymore. The price should have really come all the way. It should have cleared this gap down without difficulty. The fact that it didn't, and especially with all, the positive, usually you get a lot of volatility in the run up to earnings. We didn't see that. And now we're sitting in this area that should have given us a much more substantive run to the upside, because that's where all the buying volume was. We've been sitting in that buying volume area for 2 weeks, and we're just not getting the move. And it looks like here the MACD might be, if we have at least another day or two of flat to potentially slightly negative action, we could be coming all the way down to the bottom of this volume area. And we might actually end up looking like Google, that goes all the way through the volume area, because we've been sitting in the volume area and we haven't been picking up any buyers. So we could actually get that support becomes resistance phenomenon, this polarity where we should be seeing buyers. The fact that there aren't buyers is now giving us this negative conviction. And then, you might say, okay, I think that it is plausible that AMD could run to the downside. And so here you might, if you have a lot of conviction on that thesis, then you might want to get into a long put, and then you would buy to open the put. And anywhere between the current price and the price that you are targeting, I don't advise getting anything less than a 16 delta, because then you are outside the 1 standard deviation move. So you're outside the likely move if you get anything lower than the 16 delta. But anywhere between the current price and that 16 delta or 20 delta, really, you're still within the potential move. So you can buy to open based on your account size to catch that move to the downside. Now, in the same thing about Google, where you're like, okay, we've had so much consolidation, Suzanne, it's possible that we come back down and we try and retest this 54, but we might just stay here and consolidate and like do nothing for the next few days. I don't have a lot of conviction that this volume area isn't just going to give us a bunch of kind of noise and static as we do a whole lot of nothing. Then here, your decision could be that instead of buying a long call to take advantage of the downward price action and the expansion of the deltas to the downside, you might say, I prefer to sell a short call. And oftentimes this is also called a covered call. But if it is a covered call, it means that you own shares of the underlying. If it's a poor man's covered call, it means that you have a long call on the underlying and you are protecting that with a short call in order to avoid too much time decay or volatility decay. So you're trying to minimize some of that. Or you just do a short call and you don't actually own any of the underlying. And in this situation, the broker would want to see that you had sufficient cash to be able to cope with that position. If you're just selling naked, your obligation would be that you are taking on, quote unquote, the position of the bank, and you are promising that if the price reaches your short call position, you will sell 100 shares of the underlying. And so you take in a credit up front for taking on that, for carrying that obligation. If price never reaches you, then you take your credit and you go home and whatever. And if price does reach you, then again, just like with the short put, you have two decisions. Either you can, well, actually, if you don't own any shares of the underlying, you only have one decision, and that is that you would take whatever the loss is. However, you have taken some credit in up front. And so for AMD, I think that you would take in about $60 for one short call. And because that short call represents 100 shares, if you were to have sold it at the 68, price could actually move to the 69, and you would basically just come out flat. So that $60 that you took in would cover most of the quote unquote potential loss, because it gives you that cushion area. And then you would just buy to close the position. Now, oftentimes what happens, as you see here, price will come up to these kind of key resistance areas, and they'll like run up, hit that resistance, and then have a really significant pullback. It'll get a lot of distribution. So basically, people who were holding shares that see that price has had a nice move to the upside, an $8 move to the upside, maybe they got in at shares at $58. They don't think that the upside move is substantial, that, is going to carry on. So then they get rid of their shares at that inflection point once the gap is closed, and then price naturally just drops back. So that's why you want to sell at these key inflection areas, because on your chart, because normally you will get a price rejection at that point, which we saw. That's exactly what happened here when we hit that $64 mark, and then we just rejected it and dropped $4. So normally I would tell people that, okay, likely, what likely would happen is that price would make that run up and then potentially have a pullback. And in that pullback, you would need to decide, is this a rejection of that price level, or is it actually just a retrace, and then the price will pick up new buyers, and then we'll make a next leg higher. So at that point, when you get that retrace, that's when you need to decide if you want to buy to close for the profit that you see, or if you want to take the chance that more time will decay while price is consolidating again, but as we see here, is consolidating at that $67 mark. So the risk would be up to you. But if the thesis was correct and price does actually drop, the minute that price starts to drop away from your short call, you will see a very quick, basically deconstruction of the value. So suddenly your short call could be at 50% decay already if you get a move to the downside. So right now, let's say that you had sold to open your short call at the 68, while price was at the 61 mark, and then price drops back to this 56, you would see an almost 50-60% decay in the value of that short call, depending on how much time you sold. So we can actually look at AMD, and let's say that you wanted, if you sold, this is 1 month. So again, the 2nd of December, if you would have sold at that 68, actually you would have taken in $107. So actually price could move exactly $1 beyond you, and you would actually be slightly in profit, because you would have brought in $107. So even if price were to get to the 69, you would actually still see a very slight, but you would see a bit of profit. If price expired at the 69, you would come away with 7 cents. But if price were to just drop even a few dollars, you would automatically start to see a very fast decay in your delta. So right now, if you were to sell this 1 month contract at the 68, you have a delta of 22, and price would only need to move, if price moved $2 down, you would already be at the 17 delta. If price were to move $3 or $4, like back to this 56 area here, you would actually immediately see a decay to the 12 delta. So basically the value of that contract would have cut in half based on the delta, and it would have dropped in value because of the theta decay. So if it took a few days for price to do that, you would still have been benefiting from the theta decay while you benefited from that delta, the drop in the delta. So let me know if you guys have any questions about that opposite thesis. All right, I don't see any questions here on the Zoom, but if you're on YouTube, then feel free to ask questions. Of course, if you're watching the replay, post your questions in the chat, and then, in the comments, and we will be more than happy to get back to you with those answers. So the thesis is really the big question you have to ask yourself is, how fast do you believe the underlying you're looking at is going to make the move that you are expecting? So, and if you think the move of the underlying is going to happen rapidly, so it's maybe like price is hitting a support area or hitting a resistance area, or on the Bollinger Bands that you're hitting at those, the higher, the low area of the Bollinger Band, and you expect that price is going to snap back to the center or that volatility neutral, or you're looking at the MACD and you're seeing that the acceleration to the upside is slowing, and so you are expecting a drop, or that acceleration, the acceleration to the downside is starting to slow, so you're expecting maybe a push up. Whatever indicators it is that you are using, that's your own personal preference. Or if you're just looking at the chart and you're only charting price action, that's also totally fine. You just have to have a conviction of where price is going and how fast you think it's going to do it, because any long position you're in, you want to have some of those second derivative Greeks on your side, and you really want, and those work best, all of those second derivative Greeks, which we will talk about as we go on in the kind of conversation, not today, but in the future. You want price to have this momentum move with you in order to really see that expansive value on a long call or on a long put. And if you are unconvinced that you are going to really get that strong move, that really like efficient directional move, then selling a short call or a short put then may be the better alternative. So you are still taking in some credit while you're waiting for the right chart pattern to actually show up for you to go long. And that's really how I like to play these, is that, I want to, when my favorite setups aren't clearly there, then I want to wait for a really good setup that's clear that I'm going to get a really strong push up to the upside or push to the downside. And while I'm waiting for that kind of coiling or a particular kind of pattern to build up for me, or some technical indicators to really point that, okay, we've pushed too far down too fast, or we're way oversold, or we have, we're really sitting at a strong volume ledge. A lot of buyers have come in. Now we're going to get that explosive move to the upside. But while I was waiting for price to figure out what it wanted to do, then I was in those, short call or short put positions to be able to take in some credit while I was waiting. Because I think that the most frustrating thing when people are, when they want to learn options, they want to find setups all the time. And that's just not how the markets work. Like sometimes the setup just isn't there. But while you're patiently waiting, it doesn't mean that you can't be paid to wait. You just won't make as much money. Like, you know, you do make a lot of, you do make money faster when you go long, and you are correct, and the move happens very consistently. So it doesn't necessarily have to happen like in the first minute that you open your position. But, you know, if you have a nice solid move like this, where price moves from $71 up to this $100 mark, that's a huge move. And if you were in a long position, that would have been just a beautiful catch. And you would have been extremely profitable, depending on how you set up your long call, at the money, out the money, or whatever. If you would have set it up in maybe a different kind of structure, like a debit spread or something similar, like, yeah, that would be a great position to catch. But imagine if you would have done a long call here, expecting this kind of move, but ended up literally with zero move, and you were in this position for 2 weeks. You would be entirely frustrated, because actually you would just have been losing money, and you would just have to decide, do I sell to close my long call because price has done basically nothing? And, you know, that would be your decision to make, but it would be really annoying. So while you're waiting for price to really find its actual bottom, this is a great time to sell a short call, because yes, you're not making, you know, thousands of dollars, but you're making $100, and you can do this on more than one underlying. And, you know, if price makes a drop faster than you expect, you can buy to close your short call. And then if you have the right setup to go long, you're just taking the money that you achieved from that short call. You're taking some of that and adding it to your new long position. So your long position becomes almost free. And then you don't have the pressure of, is it going to work out? Is it going to be perfect? Because you didn't pay a lot, because of the fact that you actually already took in some credit while you were waiting for the right setup. So I think that, you know, the pairing of the strategies works really nice especially for those who are really confident in their charting skills. So I know that there are a lot of people who trade, are very focused on price action trading. So they are really confident about what their, you know, directional moves are going to be for the day. And, you know, when those aren't set up, if that, you know, your favorite kind of chart pattern isn't sitting there, and you don't feel like you're going to get that, you know, strong move directionally to the upside or to the downside, then it's absolutely okay to sell a call or sell a put against the move of the underlying that you're expecting. So if you're expecting a bullish move, sell the short put. If you are expecting a bearish move, then sell the short call. And then while you're waiting for the setup, you're taking in some extra cash. So let me know if you guys have any other questions, or if you have any questions, I should say. For some reason, I don't see the.
No questions on YouTube.
Yes.
Sorry, no questions on YouTube.
No questions on YouTube. Okay. So one of the things that, like, you know, for those who are going to be watching this later, there is just one more thing that I would like to share with you guys. I think that oftentimes if you have a smaller account and you're trying to make really fast money, it will be enticing to trade underlying that are, one, very volatile, and two, have a very high cost of entry. And that can be really fun when it's working for you. But when it doesn't go right, you can see losses very quickly. And 3 areas that are just brilliant that I think will do really well. Their value will hold up well during this coming inflationary, well, we are in an inflationary environment, but where companies are actually starting to take the heat on interest on money that they're borrowing. 3 areas that will continue or are doing well and will continue to do well are the XLE, so energy. I think that we will continue to be in an energy bull market, you know, in the coming years. And that's because even though we may have solved the energy problem for this particular part of the winter, we do not know that we have solved it for the rest of the winter. And we do not have a solution for next winter. And so as long as all of those kind of questions remain remain kind of out there and unsatisfactorily, I don't know if you want to call it, they're not satisfyingly answered, we will continue in a commodities bull market. And I just think that there are many structural issues that go along with that. And so, and the XLE will continue to do well. And the XLF, I think, is, as it's proving, in spite of the fact that the rest of the market has already seen massive drawdowns. Right now, if you would have bought XLF, like at the okay, everybody calls it the COVID lows, at the reverse repo lows, because that's actually was a financial crisis at the reverse repo, in the reverse repo market, where there was no liquidity of US dollars. So it caused this massive drop in prices, but it did come at the same time as the COVID news. So if you would have bought XLF at these lows at the $18 mark, you would still be up. Let's see how much. You would still be up 100%. Now, if you would have only bought XLF at the very top at the $41 mark, you would be down, but you would only have been down 17%. And in relationship to other underlyings that are down like 50, 60%, that's 17% is not bad. But the fact that XLF is not excessively expensive to get into, this is an underlying where you might actually want to consider getting in shares. It does pay a dividend. And then you can actually sell covered calls, and still they're called short puts, but the amount of cash you have to have on hand is much lower when you actually own the shares of the underlying that you are selling against. And the XLF is not extremely volatile, so you won't bring in a huge amount of money week on week. But if you were to have, to be scaling into shares, I think the XLF just overall is going to do very well in like through 2023 because of just how the economic markets are shaping up. I think XLE will continue to do well. I think that it is very likely that we will start that, we could see the price of barrel continue to roll up even beyond the $100 mark. So there is a lot of potential for XLE to get up above this kind of previous high and continue to move higher. If you didn't want to take the risk of buying shares, quote unquote, at the all-time high, then you could do, you could sell, well, depending on what your directional assumption is, you could sell either short calls or short puts to scale in to cash and then roll that into actual shares. But of course, the XLE is much more expensive than the XLF. And then the other one is healthcare. I think that healthcare has proved to be a very, wow, this is a very exciting chart I have. And I didn't realize I still had all my markings up, but I do think that healthcare is going to continue to do very well. insurance is going to continue to be an area of the market that does well. I think healthcare is going to do better than utilities because many aspects of utilities are in fact affected by the rates of inflation. And so sometimes, yes, you need your utilities, and yes, you will pay for your utilities, but it is an area where people will where there could be demand destruction. How much electricity, how much gas, so on and so forth. How much do you actually use month over month? People will try as much as possible to contract those costs, but healthcare tends to be a cost that, you know, you're not going to suddenly change your cost of insurance. You're not going to suddenly change the cost of any prescription medications that you're on or your co-pays and things like that. So this is an area that I think in, you know, generally in this kind of market, healthcare will tend to actually potentially outperform utilities, which tends to be the area that people go to in when, you know, in areas where times when growth is not doing so well. But because of the fact that we are in a high inflation environment in the commodities, I think that could have a very negative, and we have a lot of supply chain issues that will have a negative knock-on effect to utilities. So if you're looking for underlyings that are not as cost prohibitive and that aren't as massively, you know, like they don't whiplash as quickly because of volatility, then, you know, trading the spider ETFs that could help you. And I didn't mean to put in XLP, I meant to put in XLV. Wow. And you can see it's maintaining its price action a bit better, but it is a bit more expensive. It's $130. But I'm not surprised considering that it has things like Cigna and UNH, which are very high value stocks. But as you can see, the trajectory is picking up to the upside. And though we are currently at a bit of an overhead resistance, you know, this might be a time where you say, okay, I think that we're going to get a bit of a pullback. So you sell a covered call while price is figuring out what it wants to do. And then you see if it comes back and interacts either with this kind of volume ledge that is around the 125 and see if you get a bounce up. So you can ride this down with a short call and then ride it back up with a long call or even with a short put if you're not convinced of the strength of the move, and then see how that kind of evens itself out. On the MACD, it does look like it's turning negative. So, you know, you might want to just stick in a covered call while you're waiting for price to even out. But I think that over the long run, like if you want to trade something that owning shares is not prohibitive and is actually preserving the capital, unlike some of these stocks that are already, you know, 50-60% down and could still see downside pressure till the companies really figure out how to be profitable. These three areas would do really well. And you might just want to pick the top performing stocks in those sectors. So you don't necessarily have to get XLV or XLE or XLF. You could just find some top performers that could outperform into the coming months. And then you would be trading in a potentially stronger area of the market instead of only trading in the high volatility growth areas that, yes, can give you massive moves day to day, but can also just chop up your account if those aggressive moves are not in the same direction that you are planning. So, all right, if there aren't any questions, then feel free to, those watching afterwards, feel free to get in the comments and we will get back to you. If you're not part of the Telegram and you would like to be, either reach out to us. My Instagram handle is there at Trade Speakeasy. And of course, you can always reach us in the comments on the YouTube video, or you can connect with us through our website at, well, tradespeakeasy.com and then you can have, you can email us. So yeah, let me know if you guys have any questions, and I hope you guys have a wonderful evening. It's already like 2 o'clock in the morning, so it's already Friday. So I'm already having a good Friday. I hope you guys have a wonderful Thursday evening. And I will say goodbye
Thanks
for
so
now.
much, Suzanne. Thank you for that and for staying up late with us.
No, that's not a problem at all.
Absolutely. Thank you.
Yeah. I like seeing you guys. It was nice to be back after a few weeks away, but I will say good night now. If I can find where the end is. All right, there.